Ladies and gents, welcome back, everyone. We hope you had a good coffee break, fruitful discussions. Now we are really going to dig into the theme of the global trade war and the fallout of that. And I've got with me my esteemed panelists. To my left, João Aguiar Machado. He is the EU ambassador to the WTO. He's also spent, I think, more than 2 decades at the European Commission. Thank you so much for being here. Really appreciate it. Then to his left, Ralph Ossa, UBS Foundation professor at the University of Zurich, and of course, former WTO chief economist for 2.5 years. Always a pleasure having you on a panel. And last but not least, Hélène Rey. She is the Lord Bard Professor of Economics at London Business School and the Center for Economic Policy and Research Vice President. Thank you so much for your time as well. Before we kick off with a number of inputs from these panelists, I want to ask you a question, ladies and gentlemen. Please get out your phones once again. The question I have for you, and then maybe later on the panel can reflect on that, is international trade entering an era of permanent decline? Yes, no, or only in specific areas? Is international trade entering an era of permanent decline? I won't show you the outcome just yet. I'll just leave a little bit of suspense in the room and see what this room thinks. And let's listen to the experts now with a few inputs. Ralph.
Well, thank you very much, Caroline. And I was actually looking forward to finding out now what you think, whether international trade is a permanent decline. I can tell you right away, I don't think it is. But that's not what I'm here for today. What I'm here for today is to give you a quick overview, my own take first on the current situation, then also what I think the implications are for international trade, and lastly, what I think the key priorities should be now in terms of our policy response. So let's jump right in and take a look at the current situation. And the main message that I want to get across is that yes, US tariffs have risen sharply, and yes, this is a serious problem, but it is a problem that has limited reach, much more limited reach than most people appreciate. So if you start with the chart on the very left, what you see is the US average tariff. It's a trade-weighted average tariff, and as you all know, it has gone up significantly. And this is important. First, it's important because the average US tariff is now as high as it has not been for many, many years. You have to go all the way back to the 1930s to find comparable tariff rates, so it's clearly significant. It's also significant because it's not just any country imposing these tariffs, but it's the United States, which has traditionally been one of the main sponsors of open trade and more generally the rules-based trading system. So I just wanted to make that very clear. Of course, there is a serious problem. What's a little bit less known is what I show in the middle, which is that the US is actually not as important in international trade as many people think, including, at least you get the impression sometimes, the United States government. So what you see here is world imports, merchandise imports, and what share of world merchandise imports goes to the United States. And what you see is that only 14% of world merchandise imports go into the United States. 86% go into the rest of the world, which means that the rest of the world collectively is much more important. And one implication of this is that, of course, it's important now to come to terms with the United States, to find cooperative solutions with the United States, but not at the expense of rules-based trade with the rest of the world. And if you know that, then you may also not be so surprised about what I show on the right-hand side, which is that most of global trade continues to be rules-based and not power-based. And I think it's so important because everybody talks about the end of the rules-based order, everything being power-based. And again, I'm not trying to minimize the problem. Oops. Oh, no, you're still there. Sorry. I'm not trying to minimize the problem. But if you look at it, you see that 72% of world merchandise trade is still conducted under the tariffs negotiated at the WTO, the so-called MFN tariff, and the remaining, I have to look carefully now, remaining 16% is conducted under preferential trade agreements, so not agreements that are negotiated at the WTO, but agreements that are consistent with the rules-based trading system. And only 12% is really what I would call non-cooperative. That's essentially the US tariffs and the responses by other trading partners. And that's an important point, because if you realize that the rules-based trading system is still alive, you also realize that there's a great danger in not acknowledging that in policy conversations, because it can easily become a self-fulfilling prophecy. If we all think, well, nobody's following the rules anymore, then of course we might be tempted to now also not follow the rules, and then this can become a self-fulfilling prophecy. So clearly a major problem, but a problem so far with limited reach. Now, what is this going to do? What are the implications of the tariffs that we currently have? And here again, you see a bit of a mixed picture. Well, of course, if you impose tariffs, that is going to slow down trade growth. According to the latest estimate of the WTO, the tariffs cut global trade growth by half. So in the latest forecast, the WTO Secretariat estimates the volume of world merchandise trade to grow by 2.4% this year, 0.5% next year, so combined 2.9% over 2 years, which is about half what they would have expected without these tariffs. What's interesting, by the way, and that relates to what Raghu was saying in his keynote at the beginning, that actually this year doesn't look so bad. So really, we would only expect the real consequences of these tariffs to become visible next year, simply because there was a lot of front loading, there was a lot of trade that took place in order to avoid these tariffs, which, by the way, in April, when I was still responsible for the trade forecast, we didn't quite anticipate. So this is quite a correction from what we had in April. So then, my last point: what is important now in terms of the policy reaction to this situation? And for me, if you remember the first slide that the tariffs come from the main issue are the trade relations that involve the United States. And if you also remember that that's a relatively small share of global trade, for me, the key priority now is that we make sure that the trade tensions, which are relatively isolated, that they don't proliferate to the rest of the world. And I see two particular channels through which such proliferation could take place, and relatedly also two main risks. The first risk is what I have in the first column, are basically trade deals with the United States that are discriminatory. And I have a picture here of von der Leyen, but that I could have put any other picture. Basically, what you see is that all trade deals that have been signed with the United States, at least the ones I'm aware of, Japan, South Korea, European Union, UK, Thailand, Indonesia, and so on, they all share the characteristics that the countries made unilateral concessions to the United States without extending the same concessions to other trading partners. So these are discriminatory deals that come at the expense of third countries, which of course could provoke trade tensions, but they also go against the key principle, I would argue, of the WTO, which is a principle of non-discrimination, that you're not supposed to discriminate against other countries. Now, again, of course, I completely understand that countries want to come to a cooperative solution with the United States. I'm just pointing out that that should be done in a way that does not jeopardize trade relations with the rest of the world, given their importance. The second channel through which trade tensions could proliferate are trade diversion effects that are not well managed. And the big concern, of course, are Chinese exports that used to go to the United States that might now get diverted to other markets, including the European Union or also Switzerland. And this is clearly an issue, so I don't want to debate it away, but I want to put it in perspective with 2 points. The first point is that bilateral trade between the United States and China accounts only for 2.4% of world merchandise trade. Yeah, so generates 80% of the news, but less than 3% of world trade. So there's a cap for how bad these trade diversion effects can be in the aggregate. Doesn't mean it can't be important in steel or it can't be important in cars, but in the aggregate, not that important. And the second point I want to make is that these trade diversion effects are, of course, bidirectional. It's not just Chinese goods that need to find other markets, but it's also European, it's also Japanese, it's also European goods, Korean goods that need to find other markets. So I think there's scope to handle this cooperatively. And then just the last point I want to make is that, of course, another proliferation risk is not a geographic one, but a sectoral one. So at the moment, the trade tensions are limited to goods, not services. Services now account for a little over 1/4 of international trade. And it's a bit of a mixed bag because on the one hand, services trade, that's where some other countries actually have some leverage because the US is a net exporter in services. But of course, this is also where the escalation risks are high if you think about finance, big tech, and so on. So with that, let me already conclude. So key takeaways first, yes, we have a problem, but the problem has a more limited reach than many people think. Second, of course, the trade outlook has deteriorated, but we are not going to see a collapse of international trade given the trade tensions that are in place now. And third, let's be careful how we manage this. Yes, let's try to come to terms with the United States, but not at the expense of deteriorating trade relations with the rest of the world.
Ralph, thank you so much for this. Any questions to Ralph, please put them or type them into the tool, and I will put them to him later on through my iPad. Hélène?
Good to see everyone. Delighted to be here on this panel with my distinguished co-panelists. So I'm going to take it where Ralph has actually left us, and in fact, set a little bit more of a stage in terms of the importance of these trade links between, in particular, the US and the rest of the world. So what I'm showing you here is a trade network in 2000. So it's year 2000, it's before China gets into the WTO. And you see these big nodes, which are the countries. The biggest one here is going to be the US, but you have also the European Union, and you have a number of important nodes. But the size of the nodes is proportional to export and imports of these countries. And the arrows that you can see indicate the exports from one country to another country or region. And you can see that there is a lot of density in that network, and that's before China enters the WTO. Now, if I move forward towards 2019, you're going to see the change in the network here is pretty striking in terms of trading goods. You see that now we have been moving from a network in which there were two big nodes, which were the US and Europe, essentially, with three big nodes, which are the United States, China, and Europe. So we have gone really to a world which is really tripolar as far as international trade in goods is concerned. And you can also see that the density of these connections of a network has actually also gone up. So we are really living in a very, very interconnected world. And I want to contrast this trade in a goods world with another network in the international economy, which will make also a link to with what Raghu has been talking about in his lecture, which is the international finance network. So here, what I have is a network which is based on cross-border investment, what we call portfolio investment in international finance. So it's investment in securities. It can be stock, equity, it can be fixed income. Okay, these are securities, and these are the cross-border positions. So again, you see these big nodes here. You see the United States, very much in the middle. You see Europe, which is quite important. And in that network, this is also year 2000, you cannot really see China. Right, it's somewhere it's a small node in the periphery. The size of a node is also, proportional to the size of the cross-border investments. And so you can see China is very small. And actually, if we move towards 2019, now what is interesting is that the US and Europe are still very much interconnected and very much kind of in the middle of the system. And China has grown. Maybe you can locate it in this graph on the periphery, but it's actually not that big compared to the two others. So we are still very much in a world in which the US is dominating in international finance, Europe is important, and China really has not caught up. So that's a very different, there's a very big asymmetry between the world of international trade, in which we are in a tripolar world, and the world of international finance, in which really we are still in a world dominated by the US, with a sizable also role for Europe. Now, this is the interconnections as they were in 2019, 2020, and what has been happening, and Ralph has been talking about that a lot, is a number of shocks, very important policy shocks. So the trade war, we also had obviously COVID and the Russian invasion of Ukraine, very important shocks which are reshaping to some extent these networks. And so how are they reshaping them? Well, we start to have a number of very interesting academic papers looking at that from the point of view of firms. And what I am showing you here is some work which has been done using earning calls of firms and asking companies, what are you doing because of the tariffs? What are your reaction to the tariffs in terms of relocation of supply chains? And then I will show you some other type of actions that firms are taking. But so here the first thing is, what is happening to these networks, this international trade network? And what we can see is that in reaction to the tariffs, firms are changing indeed their production network. They relocate out of China to a large extent, to some extent into the United States, but very much into the so-called connector countries, Mexico, Vietnam, Malaysia. So instead of trading directly from China to the US, you have the supply chain going through essentially these connector countries. So you have different, longer supply chain as a reaction to what is happening on the trade, as far as the trade war is concerned. So that's for the supply chain responses. But there are other types of adjustment that companies are taking. Some adjustments are, well, for the companies, the US companies, which are affected by the tariffs, what is happening for them, this is firm in the sender country. In the case of tariff, this would be, for the Trump tariff, this would be the US. They are in the sender country, and the receiving country would be China, for example, or Switzerland. So firms in the sender country, in the US, what are they doing? Well, they see that the cost of their input is going up, so they increase their sale price. That's one of the major type of response. But what is very interesting is that you see that firms in the receiver country, and that's going to be, for example, Chinese firms, in response to export restriction in particular, what are they doing? Well, they are increasing investment and they are increasing R&D. So there is increase of technological innovation to try to somehow bypass a little bit these trade shocks that are being imposed upon them. All that does have negative effects. By the way, you can see that on profit margins. You can see that at the very right of the slide. It hurts both firms in the sender country and in the receiver country. But you can see that there are two types of adaptation, via the supply chain and via technological innovation and R&D, which is happening. Now, in parallel to this reshaping of network because of a trade war, because of a tariff, because of the export control, because of the financial sanctions, there's some other things that have been going on inside networks. So here, what I show you is a totally different type of network. This is the supply, in a way, the trade network for one critical mineral for green transition, which is lithium. But I could have taken any of the other critical mineral for electrification. What has been happening in between the 1990s and now is that China, very interestingly, has managed to position itself very much in the center of these mineral networks, of these trade networks for critical minerals for electrification. Not necessarily because China is mining them, but China has preference supply of these minerals, processes them, and then consumes some of that and re-exports some of that. So there's really a kind of China has moved to the center of this network very much. So to some extent, the way I would characterize what has been happening in terms of policies vis-à-vis trade and to some extent vis-à-vis finance is the comeback of coercion in the international arena. We can see this is a very old concept that goes back to Albert Hirschman, effectively, which is effectively, you can position yourself in trade networks. You can use tariffs in order to try to constrain other countries to do certain things. Okay, that's the concept of coercion. This is very much a kind of in the geopolitical realm, and there's a lot of papers written right now on geoeconomics in academia, which speak to various aspects of these issues. So in the aggregate, if we look at trade, we may not see actually much of a decrease in trade, as Ralph pointed out, but what we do see, or seem to see, is a change in the shape of these networks. Okay, and I think that's important to realize that. And both the change in position and the increase in R&D, the technological innovation, are about increasing sovereignty, resilience to geopolitical risk. Now, if I just, to finish, talk a little bit about international finance, I think this has implications for currencies and international finance in general, because as we have just discussed, we used to have, China-US trade directly, and so that would be done mostly in dollar. Now, if we go China, Mexico, US, or China, Vietnam, US, there is scope for more currency competition, in particular for the RMB. And at the same time, the geopolitical tensions have also stirred in various parts of the world the emergence of different payment system in order to increase sovereignty. So that might or might not lead to further fragmentation on the international finance side. As far as the role of the US dollar is concerned internationally, so this increased competition is there, definitely. The fact that we might see also an increase in cryptos, which may or may not decrease transaction cost. If it does, if it decreases a lot of transaction cost across many currencies, then that makes the so-called vehicle role of the US dollar less relevant. What is the vehicle role of the US dollar? Is the fact that if you are Malaysia and you want to trade with Mexico, now essentially you trade, you use your currency against the dollar, and then you use the dollar as an intermediary to buy Mexican peso. So you go through a vehicle currency. It's like going through a hub. When you take a plane, you fly through Chicago, and then you fly from Chicago to somewhere else. You go through a hub. In international currencies, usually the hub is the US dollar. If we decrease transaction cost across the board, then that may decrease the vehicle role of the dollar, and that may therefore decrease the role of the liquidity in dollar overall in the international economy. Now, that's one possibility. Another possibility, as we have seen the US administration pushing US dollar stablecoin a lot, is that on the other hand, we see more dollarization of the world economy. So I think one of the big questions is whether US fiscal dominance is extending to international finance and international trade, in the sense that the US having big budget deficits, it's now using a lot of tariff revenues, to decrease its deficits. And it's also pushing US dollar stablecoin explicitly in order for more people around the globe to buy US treasuries. So that's a very different types of motives in the international arena compared to what we had before. And finally, very last slide, maybe we have seen a warning shot for the US dollar. Here, what I have done is that I put side by side markets' reaction in long-term bonds, so 10-year bonds, and exchange rate for two big shocks. The first one on the left was COVID, and the second one on the right was the Liberation Day shock, so the tariff shock of April 2nd. You can see that my little arrows, they go in the opposite direction. Why? Because at the COVID shock, we had the typical reactions of market. US is a safe haven, meaning everybody was going into US treasuries, and the dollar was appreciating. That's what it means to have all these points in the northwest quadrant here. Everybody flight to quality into the US dollar. That was the COVID shock. And you see on the right, my arrows are pointing exactly the opposite. it was actually after the Liberation Day shock, depreciation of the dollar, people getting out of US bond markets into the rest of the world. So exact polar reactions, very unusual. It hasn't happened before. Usually global shocks, the US is the safe haven. Liberation Day, it was the opposite. So maybe that's a warning shot. Let me stop here.
Thank you so much. Ambassador?
Thank you, Caroline. And first, I would like to thank the UBS Center for the invitation to be here. It's a great pleasure to me. Well, we are witnessing right now the major overhaul in the international economic order and trade order of the last 75 years. The system that was created in the aftermath of the Second World War, based first on the General Agreement on Tariffs and Trade, the GATT, and later the WTO, relied on open trade based on rules-based trade, creating stability and predictability for business, which is essential. And this created opportunities for increasing export in the post-war period and created prosperity worldwide. I agree that we realized later on that there was inequalities that were not being addressed by domestic policies. Trade cannot correct that. Now, this order that was created and led by the United States now has jumped outside. The US is applying arbitrary tariffs, even to islands with penguins, as you know. It's using tariffs as a way to obtain concessions and to force countries to change their policies. And at the same time, we have other countries that are using the dependencies that were created to weaponize trade. I'm speaking about the critical raw materials and the export controls that we are witnessing. So we are moving from a rules-based order into a power-based order. I agree very much with Ralph that the vast majority of international trade is still being conducted on the basis of WTO norms, and let's hope that we can isolate the US problem and that the others continue to trade respecting the rules. I have my questions about it, because we have not yet seen the side effects of the US policies on the others, and Ralph touched on it. For example, if China starts deviating exports into the European market, I can tell you this will be a huge problem. So we have not yet seen the consequences of the new policies of the US will have on the others. So I have doubts that hopefully the system maintains, even if the US is sitting outside, but very likely as we go further, there will be political pressures on governments, and you know how it is, politicians saying, well, if the US has abandoned, why are we respecting? So it will be a difficult climate that we will be living. Now, the European Union remains fully committed to the WTO system. We are participating in reforming, in discussions to reform the system, but it will be a hard time. It will take many years, in my view. For one thing, the whole architecture in the post-war period was led by the United States. And now to lead without having the US, in the past it was US and EU that essentially led the negotiations. Now that US is sitting on the sides, but still being a member to make sure that nothing progresses, this is going to be a tough job. It will be. What I'm trying to say by that is that even if we can preserve the rules of the system for trade among the others, I don't think we can expect the WTO in the coming years to be the forum where you negotiate new rules. New rules to address the current issues, be artificial intelligence, climate, or other issues, will have to be negotiated elsewhere. With 166 members and the huge divisions, I don't see any prospects. Now, in the face of this volatile and changing environment, what is the European Union doing? Essentially three things. Number one, we still remain very committed for trade. For one simple reason. The European Union is very dependent on trade. We are a collection of nations that are traders. We know that world growth, economic growth, in the next decades would be generated outside Europe. European growth is very insipid these days. So if we want to continue to maintain our social model and economic growth, we need to be connected to these outside markets. Therefore, we need to be trading with them. We export a lot. Trade contributes a lot to the GDP of the European Union, and we also import a number of inputs that are necessary. Just so that you know, 2/3 of European Union imports are intermediate inputs. Many of them go into products that we often re-export. So we need to be connected to the world. And we have already the biggest network of trade agreements in the world. We have about 44 free trade agreements with 76 nations. And we are continuing. Recently, we concluded with Mercosur. I know that EFTA also has negotiated and concluded. We are going to sign next month the agreement with Mercosur. We have recently concluded with Indonesia, and we concluded also with Mexico, an upgrade of the old agreement. On top of that, we are pursuing negotiations right now with Thailand, Malaysia, Philippines, Indonesia, we also concluded recently, and United Arab Emirates. Thirdly, we are doing, on top of these comprehensive agreements, more sector-specific agreements. For example, we have done recently on digital trade with Singapore and South Korea. We have done with Angola and South Africa sustainable investment trade agreement. So we are also doing more sectoral agreements. At the same time, we need to manage the relationship with our two most important trading partners, the United States, where we continue discussions because the negotiations are not finished. We continue discussions with the US, trying to be constructive and positive, but looking also at the interest of the European Union, as it should be. It's not easy, but we continue to engage regularly. Secondly, with China. It's more difficult, it's more challenging, because the Chinese continue very much with an economic policy that is basically state-led, that induces overcapacities, and that is very much tech-dominant, and that reduces the space to find areas of convergence. The dialogue continues, but is very challenging, the discussions that we are having with China. Now, we have learned during the last couple of decades that relying on open markets and only on free market mechanisms can be dangerous, because it brings prosperity, but it creates a lot of dependencies. And the European Union has learned firsthand that creates terrible problems. We created dependencies vis-à-vis Russia for energy, oil and gas. We created dependence with China for the market, and now the raw materials. And we created dependence with the US on security. And this creates a situation that is not sustainable. So the second plank of our strategy right now is economic security. We are developing a strategy. Unfortunately, today I cannot go much into details of it because it will be published next month or beginning of January. It's planned to be in December. For the first time, we are devising an economic security strategy. How to deal with these dependencies, what sort of instruments we have and which ones we need to create. because we are in a world that you cannot be completely dependent on others, and we need to minimize these dependencies as much as possible. The third plank of our strategy is to complete the single market of the European Union. The single market is still not very complete as far as services are concerned. And one of the big deficiencies that we have never yet overcome, and discussions are ongoing, is to create a capital market, a capital union, whereby right now there are a lot of savings of European citizens, but they found their way into the US for the pension funds and others that are going to finance the startups in the US. We cannot tap on our savings because they run across the Atlantic. And a big discussion happening right now in the aftermath of the reports of Draghi and Enrico Letta that were published last year is to complete the single market, particularly on financial services and on the capital markets union, which is very important because, again, the European economy is not growing as much as necessary to maintain our social model. We need to increase productivity, and unless we complete the single market, we are going to face difficult choices in the times ahead. So this is the three-plank strategy that we are deploying right now in face of these very volatile and changing international economic environment.
Ambassador, thank you so much for that. And I do see that the EU has a plan in place. We're all crossing our fingers when it comes to the implementation of that. That said, we need to go back a couple months and talk about Scotland when Ursula von der Leyen struck that deal with Donald Trump. Was that really a good deal? Because you could argue that the EU at that point in time lost a large part of its credibility because it is a defender of the rules-based system of multilateralism, yet by signing that deal, it violated the WTO rules. What's your response to that?
Well, I mean...
And Ralph is laughing because that was your implicit criticism before, wasn't it?
No, it's a very good question. I mean, the EU, the multilateralism is an instrument, it's not a hand in itself. And the EU remains very much attached. The deal that was done with the US, let's be honest, it was the deal of the possible. And if you look at the deals that were done with others, and if you take into account the exemptions that were created, we are paying an average effective tariff lower than 15%. It's about 9%. The deal that UK made, the baseline is 10, but the MFN rate is not included. So in many cases, it's 10 plus 4, which is almost the 15 that we had to do. So if you look from that point of view, and I think it's the realistic, realpolitik, because in Europe the companies were ready to pay this surcharge, but to have predictability, as long as we can, as much predictability you can expect with this administration, you never know. But business wanted to have some stability in transatlantic trade. Of course, we tried, as good European officials, I can tell you, when we started the discussions with the US, was to say, okay, you are not happy with our trade, let's negotiate an agreement. We go to zero, both of us, for industrial products. And it went on, and several times we said, let's go to zero on industrial products. And at some point, the Americans said, you have not yet understood what is the game here. The game here, you go to zero, and I go to 15.
I mean, there was a lot. There was a lot going on. There was 0 for 0, and then there was the threat of the anti-coercion. There was the threat of taxing some of the big techs. But at the end of the day, it's pragmatism that prevailed, I assume. Ralph, let me ask you. Was that the right thing to do? Do you think at the end of the day, it's defense that trumped everything economic, no pun intended?
I mean, I do think you also have to be realistic about the realpolitik here and see what was possible and what was not possible. So for me, it's not so much about Was it the right deal? Was it the wrong deal? Of course, I would have wished for something else. I can also be honest and say that it disappointed me and hurt me as a European to see something like that come to pass. But I think the key now is how do we present this? And I think what I would and what conclusions do we draw? And for me, now running around and pretending that this is a fantastic deal for both sides, I think that would not make so much sense. But I think just to see it for what it is and say, look, we were dependent in terms of security, in terms of needing the market, in terms of perhaps also access to some critical services, finance, AI, and so on. But now let's draw the right consequences. And I think one right consequence, and Ambassador Machado has said it very clearly, is to push forward with the completion of the single market, particularly the capital market union. Because, of course, everyone who has taken an economics class knows that the trade surplus of the European Union and of any other country is equal to domestic savings minus domestic investment. So if you want to do something about the trade surplus, you need to increase investment in the European Union. And I think the obvious way to do it is by integrating European financial markets, which would be good for Europe, and it would also help alleviate the trade tensions. So I'm a bit of of course I can't be happy about the deal. I was shocked when I found out about it. But I think now you also have to look forward and you have to say, well, what do we do about it? Because it probably was the only thing that was possible at the time.
And I assume the goalpost or the perspective is changing all the time, because first the UK got the deal, that wasn't seen as great, then the EU got the deal, and the Swiss and the Indians got the short end of the stick, so they'd be happy to be in this kind of situation. Hélène, you talked about currencies, and that's quite interesting because the dollar, as you said, had a surprising move on the back of Liberation Day, and was no longer the safe haven or the trusted asset. And the EU, the euro saw a bit of a renaissance, if you want to call it that. Will it ever rival the US dollar? I know we have a bigger discussion on that later on, but in terms of the portfolio flows that you've seen, and of course a lot of it is around the fiscal spending that's happening in Germany, can the euro really live up to this moment?
So I'm going to answer this question, but I just would like to add something to what my two fellow colleagues just said. I think to some extent the issue also with a trade deal that we have seen between the EU and the US clearly is because Europe does not have currently a credible independent defense. And so as long as the issues are going to be linked by the US administration, the bargaining power is clearly more in the US. And so the way for Europe forward is to build up the hand for bargaining, which is in particular to construct a credible common, as much as possible, European defense. I'm not talking necessarily about all countries, but at least something that is a reasonable deterrent. And I think that's going to be very important. That fits into the sovereignty themes that I also had on my slides here. Now you're asking about the euro. So indeed, we saw this very unusual movement of the dollar, which looked more like an emerging market currency than a safe haven currency, and that was a first. It doesn't mean that there were there are huge continuous outflows from the dollar. I think what we saw is a reassessment of the risk of many investors who were very, very exposed to the US dollar. For many years, the investment, that's the famous dollar exceptionalism, the investment was US equity markets without hedging the currency risk, a joint bet on the US equity return and on the dollar appreciation, which did very, very well for many years. And so positions were very, very heavily exposed to this dollar risk. And as it became clear that the US administration is eroding some of the very important fundamentals of US long-term growth in terms of attacks of institutions, right? Independence of the Fed, for example, independence of the justice system, So corruption around cryptocurrencies and all that, I think these issues have led a number of investors to be a little bit more skeptical about the long-run return in the US dollar area, and therefore both of rebalancing at the margin, but also of hedging the dollar risk. So there was a lot more hedges of the dollar, which led to a dollar depreciation. And I think this kind of long-term effects, doubts on the institutional setup of the US is still here. Which obviously does not mean that the euro is going to suddenly replace the dollar or the RMB, for that matter, even farther down the line. However, I think it makes sense for investors to be positioned a little bit more across currencies. And so the emergence of a bit more multipolarity, this, I think, is here probably to stay. The euro has a card to play, as we have seen from the networks, very big trading power. Financial markets are developed much more than in China. China has restrictions on the capital account, so that's really a big break on the internationalization of the RMB. But Europe has some homework to do, and it was just alluded by my fellow panelists. So evidently, we have been talking about this capital market union for the last 20 years. Well, how about we are doing it, right? You can call it savings and investment union if you like, but how about moving? I think that's really the right time. And I'm hoping that we actually see a little bit more of a sense of urgency here.
And I think we have over the past half year or so, definitely. I want to go back to the question that I posed in the beginning. Is international trade entering an era of permanent decline? And let's see how you ladies and gents, how you feel about this. Let's show you the results. It's evenly split. No, and only in specific areas. So I think that gives you some comfort, I assume, hopefully. And not everything is going down the spiral, and we can hopefully, put the US issue aside. But it still begs the bigger question, and I'm talking to you two gentlemen, how to reform the arbiter of international trade, that is the WTO. Is it still relevant? How can you reform it? Is Donald Trump right in his criticism?
Well, I don't think so. I mean, what you see is that after having experienced 30 years of the WTO created by the US does not feel that rules-based trade is in their interest. And they don't feel that a binding adjudication of trade disputes is in their interest. By the way, the US never accepted international jurisdictions, International Criminal Court, Human Rights Court. The only exception was the WTO. But after 20 years, they got cold feet and they said it's not in our interest, essentially because problems with China. So, and what you see right now, everything is bilateral deals. I don't think the US will be returning anytime soon, and this is not only something depending on the current administration. We already saw with the previous administration of President Biden, he more or less maintained the same measures that Trump 1 had adopted. Because very simple, once you create tariffs, you create interest groups, and if you are going to reduce them, you lose votes. So this is a situation, and it cuts across Republicans and Democrats in Congress. So this situation will remain. I don't think international trade will reduce. What we are going to see is a more fragmented international system within large areas of blocks. There will continue to be globalization. I think it's no question of going backwards, but you are seeing there will be, in terms of supply chains, try to reshore them closer to home, or at least to countries that you take it as more trustworthy, whatever that means, and try to re-engineer supply chains to bring them to more, or diversify them. So you will see not this globalism that you saw since the 90s, but you will see still a lot of international trade, but shaped in a different way.
Mm-hmm. Ralph, let's get to some audience questions. If the U.S. is playing a diminishing role in global trade and we aim to reduce the dependencies, what is the rationale behind pursuing new trade deals with the U.S.?
I mean, let me actually take the liberty and respond to a broader question that's related to it that I'm going to pose to myself, and then I'll come to this. So one thing I wanted to add, there's a lot of discussion here about the role of geopolitics in international trade, fragmentation of the global trading system. Joao has said it, Hélène has said it, and for me, I have to say that if you had asked me a year ago, I would have said geoeconomic fragmentation is where we're going to go. But now when we saw Trump going after its closest allies, Canada, European Union, and so on, Japan, I'm not so sure anymore. So I think the future is going to be much messier than geoeconomic fragmentation. I still think it's going to have the WTO at its core, but there's going to be some messy patchwork around it. So that's one point I wanted to make. The other point I wanted to make is that especially as Europeans, we have to remember, I think, that the history of European integration is one of interdependence. I mean, think about it. When the Steel and Coal Union first came about, it was all about Germany and France becoming interdependent because they were enemies, not because they were friends. So it's like faux shoring, if you will, instead of friend shoring. And I'm not as naive as saying that, let's just reduce tariffs and everything's going to be perfect. But somehow this idea got completely lost, I think. We're all trying to become self-sufficient. We're all trying to only trade with friends. And what this means is you're investing in your weaknesses because you start basically digging up rare earths in Germany or something like that. It's possible, but it's not efficient, rather than investing in your strength and becoming interdependent. But now very, very quickly to the question. So what I would advocate for in terms of trade policy is actually exactly what Switzerland is doing, also what the European Union is doing, is of course support the World Trade Organization, support the multilateral trading system, but also go for a wide variety of bilateral deals, including, of course, the United States, because even though the rest of the world is larger and more important in terms of import volumes, the United States is still important. So I do think it's in the interest of every country to have good trading relations also with the United States.
Mm-hmm.
If I can, more practical.
Yes, very briefly. Hélène, I've got a question here for you that I want to get at. Will the European payment system have an increased role in trade?
So the European payment system, so what has become apparent as these geopolitical tensions have been rising are the dependencies, right? So we talked about dependencies in terms of rare earth. I talked about in terms of critical minerals for the electrifications. Clearly, China has been minimizing dependencies on the outside world while maximizing exports, but also in finance. So what has been pointed out, and in several speeches of Christine Lagarde and also Phil Lane, the chief economist of the European Central Bank, is that a lot of transactions within Europe depend on American companies. So if you think about a lot of a payment system, between households and also companies, they go through MasterCard, Visa card, PayPal, Google Pay, and others, Apple Pay, all Americans, right? And that means all the data, all the infrastructure is in the hands outside Europeans. And actually, for many countries, even within the euro area, there are no other substitutes which are purely euro-based substitutes. There's a few countries for which you can do a domestic transaction with a domestic company and maybe some cross-border transaction with that payment company. But for some countries, no, you have to go for one of these American-owned companies. Now, you can consider payments is a critical infrastructure, right? And if you think that, and if you want to decrease your vulnerability, then it means you have to develop your own payment system, which is part of what the ECB has been doing, or is currently doing, in terms of introducing a retail CBDC, which is a central bank digital currency. I understand mainly with a view of being a payment system replacing these American companies for the euro area, but also developing a wholesale CBDC with potentially much more integration with financial asset trades, which would be tokenized, with possibly some cross-border linkages. So all that in order to make the payment system in Europe more independent, more resilient, and also to keep up with the technologies. Because one thing, I just alluded to, is that there is a US Treasury initiative to push US dollar stablecoins very heavily outside of, in the whole world, essentially, with the explicit goal, or one of the explicit goals, is to get a lot of these companies to buy US Treasuries. Right. So whether it's good in general, there are obviously plus and cons. If you are in an economy where you have hyperinflation and you are looking for some kind of stable medium of exchange, it might be convenient to have a US dollar stable coin. In the old days, your economy was dollarized. You would use dollars or euros in order to substitute for your currency, because your currency was really not stable. So maybe a US dollar stable coin will be more convenient. So there might be some plus to that. There might be some pluses to that for people who do cross-border remittances. But there are lots of risks, right? Lots of risks. So one risk has to do with dollarization of economies who don't want to be dollarized. And that's important for monetary policy. Another type of risk is cross-border transactions which go below the radar, as a lot of things in cryptocurrency. So that means illegal transactions which are not vetted for anti-money laundering, which are not vetted for anti-terrorist transactions. So the underworld economy, that's a very big risk. And the erosion of public finances if these instruments are used for tax evasion. I think it's a very, very big risk, on top of the usual financial stability risk that people will point out. If you have a stable coin, it's a bit like a money market fund. You have no lender of last resort. So suddenly there's a run, and if there's a run on the stable coins, there's so far, no lender of last resort, no liquidity being provided. Good luck if you want to recover your money, Right. Tether, biggest market cap, incorporated in El Salvador.
Absolutely. Let's do one or two audience questions. Anyone? First row.
Thank you very much. Very interesting panel. Actually, I have a question for you, Mr. Ambassador. You mentioned this economic security plan of the European Union. Could you elaborate a little bit? Will that be completely in the framework of the WTO, or how can you enforce independence in the European Union by changing these supply chains, etc., without having an impact then on tariffs and on other trade rules?
Thank you.
Well, very good question. As I said, it's still being internally discussed, so I cannot right now start speaking on details about it. The idea is to use a mixture of instruments. We are already using, for example, trade defense instruments that are legal under the WTO, but we will be devising new other instruments, not necessarily related to trade, but can be investment. That is not regulated by the WTO as such, or for a large part government procurement, which we are also using, but it's for the first time we are devising a conceptual strategy to be discussed after in the Council with EU member states, how to ensure that Europe avoids these vulnerabilities and takes care also of its economic security, not only the military, but the economic security, which is extremely important. So this will be published in the course of next month. Yeah, and it is the first time, it is the first, we have been in discussions, there is, Japan has also adopted 2 years ago an economic security strategy. So there are more and more interest around the world to ensure that we avoid the vulnerabilities that we have been facing ourselves right now. If I can just reply,
yes,
one good question that you put, what is the motivation to do agreement with the United States right now? Very simple. Instead of paying 25, you pay 15. Instead of paying 39, I hope Switzerland, and let's not be realistic. Switzerland, and I hope so, makes a deal with the US to reduce out of 39%. Most likely will violate one way or another the WTO.
It's not such a big deal?
Switzerland may be in a good position because your tariffs are already so low, except for agriculture. But they are so low that maybe you don't need to give much. But any country who has made a deal is obliged to violate the WTO. It's simple as that. There is no other way.
Maybe final question from me. We don't even know at this point whether these tariffs are legal. The Supreme Court is debating this, and there was a lot of skepticism. So if they're not, and we'll get the ruling in a couple of weeks, I guess, if they're not, will Trump find another way? What's your best assessment, your best guess?
He will find another way, and they will litigate for another 12 years and 5 years, and he just carry on. It's interesting that one of the reasons that he said that the tariffs, the 10% floor, it's to generate revenue to pay in part for these big, beautiful budgets. Now, in front of the Supreme Court, he's saying that the tariffs is not for revenue reasons. So you never understand what's behind that. But everyone says that he will find other mechanisms, and then there will be more litigation going on, and he will carry on.
Mm-hmm. And didn't he want to give out a tariff dividend to U.S. Americans too, worth $2,000?
Yeah, I read that today. Yeah.
Yes, but I think that's to get the population on his side as we're going into midterms next year, I assume. Ladies and gents, thank you so much for that. I know there's a lot more to discuss, but I want to thank you for your time, for your inputs, your questions. We will take another coffee break, and after this break, we'll talk about how companies are responding to the tariffs. And I think, Hélène, you gave us a great insight into how that could work. Thank you so much. Thank you.
Thank you.